Generally, the way that mortgage issuing works is you go to a mortgage broker or a bank and they originate the loan by doing all the paperwork and getting it approved. And once they make that loan, they resell those mortgages to take them off of their books. Now, if you're a prime borrower, as we talked about before, government-sponsored entities like Fannie Mae or Freddie Mac will purchase and hold the mortgage or guarantee the mortgage for another purchaser. But Fannie Mae and Freddie Mac don't buy or guarantee subprime mortgages. If you're a subprime borrower, it was much more complicated. For subprime loans, selling those loans gets into things like securitization. In the secondary market where the resale of these securitized mortgages happens, there is very little oversight. The products that they come up with are complicated even for a lot of sophisticated borrowers. There are things like interest-only loans that balloon in 5 years or unlock in 2 years and then reset, but they have to be paid within a certain period of time, and it gets very complicated. And then there are the other kinds of loans with multiple payment options. And when they're selling them to you, they highlight the negative amortization payments, the payments where you're not paying the full interest rate, and the principal keeps going up. They show you that price up front, and if you don't see the other ones in fine print, well, you get the picture. It gets very, very complicated very quickly. Over 75% of these subprime mortgages were originated by mortgage brokers who, while they are licensed and have state regulatory oversight, are not the actual lending institutions themselves and are incented through the premiums that they get for originating those loans to make the loans, not to make sure you can pay the loan. And as a result of the way these loans were structured and sold, it's often unclear who the lender actually is. These loans, they get originated and then securitized, which means they're bundled up, then chopped up, and then resold to a bunch of different people. Any given loan, there may be dozens to maybe 1,000 or more actual owners of any given single mortgage. Now, because of the complexity, there are servicing companies that service the actual mortgage. These servicing companies have different incentives depending on whether they have what is called a recourse position or a non-recourse position. Now, in a recourse position, they actually have some ownership in the mortgage, and they have an obligation to pay the security holders. In a non-recourse position, they don't. What that looks like is the servicing companies in a recourse position have to keep paying the security holders whatever the agreed sum is on the agreed timeline, whether it's monthly or quarterly, and they have to keep making those payments to investors who hold the securities regardless of whether or not the actual borrower is actually making payments. So if you have some of these people in default, then these servicing companies are making payments to the investors who own only the actual securities without getting that payment from that group of defaulted borrowers. And that puts the servicing company in a huge cash crunch. And some of those servicing companies are owned by banks that are in the business of originating loans. That creates a negative cash picture for the banks, and they have responded by making fewer loans and trying to raise large sums of capital, which you may have seen, heard about in the news. Now, the way this whole system is set up to work, it was designed around these servicing companies making money. So even if the loan were to lose some money, the servicing company would still make money. And so everything revolves around these companies. And part of the way that the banks were able to get in this position is that they moved a lot of these subprime mortgages and securities off of their books into what they called special investment vehicles, or SIVs. Recently the news has been covering the companies bringing those SIVs back onto their books, and large capital infusions they've had to sought, they've looked for, to try to keep themselves afloat. That's probably more detail than you probably need, but it should give you a sense, real sense of how all the moving parts contributed to the current mortgage crisis, and specifically how complicated the subprime loans became.